Yo, what's up? Welcome back to Dadvestor. Wanted to make a quick video before everything falls back down. But you can see we've been up and down in the markets, but overall we're up. And the past couple months have been just a wild ride, right? And thanks be to God, we hit 31,000. I'm kind of surprised. I didn't think we would even hit 30 for long. But like I said, it could all go away because I'm heavily invested in the markets, as should you be. There's a lot of things I've learned since the last time I posted. I'm still running the wheel. I'm still investing in dividend producing stocks, which includes ETFs. But I'm starting to lose my interest in yield max. Probably hold on to what I already have forever, but I'm not going to add to it anymore. I'm just going to let it. It already paid me back, I think. Misty definitely did. I haven't calculated Coney, but I'm pretty sure it has. And then YMAX and YMAG finished paying me back my original investment, a long time ago. So they're kind of just going down in value, but as long as they produce something, I'll just keep on holding it until it goes to zero. But I just don't think it's worth it because it's not worth my money right now. But at this point, I'm playing with house money. So another thing, I still have the VIX hedge going on, but as you can see, but I'm kind of going to get off of it. And the reason why is because of LEAPS. So you can see below this, at this point, everything here is either a long-dated long call or an actual LEAP contract, which is a long-term equity something. I forget what LEAP stand for, but it basically is a long-dated option that can act as a stock, but it also multiplies your exposure to the upside, but severely limits your exposure to the downside. So what does that mean? Well, for example, AG. So if we go back here, this is the last option here, and it's the lowest one. It's the worst. I can never lose more than what I put in, right? So I have a lot of contracts on, and that's because I'm pretty confident that silver's going to boom at a certain point within the next 6 months, before next year. And if not, I'll close it for a small loss. Who cares? What I really like, this is 2027, so it's more than a year. So yeah, within that time frame, I'm pretty confident it's going to come up. I'm pretty confident this is coming up. It's already coming up. So yeah, this is kind of my new thing. I'm still running the wheel a little bit, but I'm going to reduce how much I do that with. And I'm only going to do the wheel on underlyings that I actually want to own, which is how it's supposed to be used. But I've been doing the aggressive wheel to generate income. And then I realized that if you want to make a play, just make long calls. The reason why is because it's basically controlling that 100 shares, and it's really limited in the downside. Obviously, you can still lose, but it multiplies how much you get out of it. So I've actually already had a couple of positions that I got a lot of money hundreds out of from these long-dated options, where in the short term, things will move, and then it will be reflected here. So this kind of captures my desire to day trade or have short-term trades, but it also gives you that upside of waiting it out. So if things are not that great for you, the stock, like AG right now, down 9%, I can just dollar cost average into it, which just means averaging in means you add more positions at these lower prices. So you buy the lows, and then you can just sell them off when it comes up, and you just have this perpetual. So instead of doing the wheel, which is, the wheel doesn't have time on your side really, because you don't have the ability to dollar cost average into it. You only have that ability within a small time frame. Here you have not infinite, but essentially an infinite time frame to add to the position. So in light of what we know about the markets, especially with inflation and with them printing tons of money to cover their debt, the United States will never allow the S&P 500 to drop more than 10 or 20%. I believe it's 20%. They won't necessarily touch it if it's just 10. But those are all buying opportunities. Once it hits 20%, they're going to boost it up. And it's too big to fail, pretty much every company in there. And what that means is that every time the S&P comes down, buy more. I don't have that kind of money. So what I'm doing is I'm using cheaper. So SPLG is a cheaper S&P 500, so it's like a cheap SPY. And then I discovered that SCHX, I don't really know what to call that for fun, but SCHX, that just sounds terrible. But the X Schwab tracks the S&P 500, or it's very similar. Technically what it is large cap. So it's the large cap, so big stocks, the biggest companies in the world, too big to fail. And it's 750, so it's the S&P 750, or the SCH. The Schwab 750 largest U.S. companies. And it's very highly correlated, obviously, with the S&P 500. S&P 500 is better, but this is so cheap. So I'm using cheaper underlyings, and I'm using options. So because these long-dated options cost less than holding 100, so this is 80 cents times 100, $80. But it controls 100 shares, so you can buy a lot of contracts on it every time the price dips. So this way you can average into the S&P 500. I think this is only 0% because I opened it today, 9/18. See, date bought, 9/18. And so the beauty of that is that you can synthetically hold the S&P 500, and not only is it cheaper to buy it, but the upside is multiplied by 100. So not really by 100, but relatively speaking, I don't know the exact math, but I do know that if I bought in the options I've bought and done this with, if I had simply bought shares, I would not have gotten as much out of it at all. So this multiplies how much profit you can make in a short amount of time. It also, you can perpetually do this. Every time the S&P comes down, buy more of this, buy more of this. And then I'm hedging with the VIX. So every time the VIX comes down from this position, if it ever comes down more than 10%, in this, on the right side it says negative 1.54%. If it ever goes to negative 10, I'm buying another contract. So this way I'll hedge my portfolio, and I'll probably cap that. I probably won't have that many of these, and then I can just roll these forward in time when we get too close, so that maybe every 5 months or something, or every 6 months, I can roll this forward to the farthest date, and that way we are always hedged, and we will lose as little money as possible. The other possibility is if this comes up really high, I can cash out. That's why I want to have 2 or 3 positions, or 2 or 3 contracts in this position, because it's the same position. But yeah, so big fan of using LEAPS, using long calls. LEAPS are better, but some underlyings don't have LEAPS available, so you just do long calls and cash out. So anyway, yeah, underlyings, I'm holding more. I'm putting more money into VU and SPLG, and taking money out of a lot of these. And this is anticipated. I'm also buying more of SCHD, because I am in it for the long game for now, and I am kind of prioritizing growth underlyings. And VU does produce a dividend. SPY does produce a dividend. SPLG does produce a dividend. These are basically the 3 S&P 500 ETFs, SPY being the most expensive. So if we go to last price, SPY is the most expensive. VU is less expensive. The reason I like it is because I can get fractional shares, and it has less of an expense ratio. SPLG actually has the best expense ratio. So, but it's just not as well known. It doesn't have as much volume. It's not as long a track record as VU. So VU is sort of my stable. SPLG is my secondary, but they're all the same. They all track the same thing, and they all produce a dividend that's about the same. So it's not a great dividend, but what I'm really doing is I'm trying to capture market gains by having these as part of my portfolio. JEPQ, I'm a little bit less interested in now because it doesn't grow that well, and the dividend isn't that great either. So it's kind of a decent, stable, long-term option to produce dividends, but in the short, like in the building phase. So it's kind of good for the graduation phase. If you're retired, JEPQ is great. I'm not. SCHD is great. I'm not. But I do want to build these positions up a little bit and then leave them there, and then I'll let them drip into themselves. But I do think that and besides the yield maxers, which are basically YMAX on down, because I do like Ulti. Ulti is my favorite yield max ETF, so I am going to build this one up to 1,000 shares or so, and then I'll leave it for a bit. But besides that, I do like my positions. I do think that I have a really good balanced portfolio in terms of what my goals are. So VU is good for everybody. If that's the only thing you do is VU and then the option strategies, you'll be good to go, honestly. SPLG is another good option. And then, but I do like having Realtor, what is it? Realty Income, whatever the thing is called, Realty Income. I do like having real estate on my side a little bit to be diversified against. It's kind of a hedge and all that. I do like having gold. So I'm going to build these positions up a little bit, but ultimately I think I'm overinvested right now just because I do want to hold more cash just in case I need it to buy things. And so what that means for my portfolio is that I'm going to slowly kind of get out of a lot of these yield max positions, especially Coney, since it's been pretty bad, and maybe YMAG. And then I'll keep Misty forever, probably. I'll keep YMAX forever and Ulti forever, because I do like Ulti. I might build that up, but YMAX and Misty have been paid off, and they've been pretty consistent, and they've held pretty well. Coney is just really bad because of the underlying. Randomly, I own Google. Just kind of having fun with that. Probably gonna sell it soon, but Google's really undervalued, so if you're kind of looking for something to buy, that's a good one. And then these two are just wheel stocks that I'm trying to wheel out of because it's kind of not worth my money right now. I'm gonna get more into the LEAPS and just have a few wheel stocks that I will be using. So yeah, 31,000. So I'm averaging about 5% per month. And if that holds, especially if I get more than that per month, then all I'll need to retire in terms of financial independence, because I'll probably work forever just because I love my job, is all I need is 170K. That's it. So I'm not that far off, like I'm doing 5% every month. I'm going to get to 170 pretty quickly, especially I have a better job now. I just got a promotion. I'm going to be making the most money I've ever made at a job, and I'll be way more stable. So I'm pretty happy. But at the same time, the market's going to come down, and you just have to realize that that's okay. It's a buying opportunity. So I do have a good amount of buying power. I want to hold more cash for now. So I'm getting a lot of dividends paying out, and I'm holding on to them. I'm not dripping. And I'll keep you updated. Also, I do need to put out July and August spreadsheets to show my profit loss. I just haven't had time because I've been